All right. Good afternoon, everyone. This is Greg Giardino of the Atlas team here at Wealth Enhancement. And I'm joined here with my team member, Steve Craffen, who's here with me now. And this is our first LinkedIn Live webinar that we have. And really today, what we wanted to cover is our work that we do with the medical community. So we regularly publish a white paper for MD Life, which is focused on medical doctors in the profession. And we had a spotlight issue, if you will, on our last issue that we wrote. So we wanted to talk maybe a little bit today more about what to look for in a financial advisor, maybe more about our Atlas team, how we work with physicians and medical doctors, how we're different, and some of the things you should be paying attention to. So today was really just getting to know our Atlas team a little bit better, and perhaps we could be a resource for you at some point in time.
Yep.
So I don't know, Steve, maybe some initial thoughts on how we may be able to help potentially some medical doctors, and maybe we should begin with, like, if you're looking for professional help, what you should look for in a financial advisor.
Yeah, and so I've been doing this for about 30 years. And we're also very different than a lot of advisors out there. First, the fact that we're fee only. We don't have the conflict of receiving commissions or any payments from third parties. So even we refer you out for insurance because you need more life insurance or disability, we receive nothing. We're not paid on that. You can think of us as actually paid consultants from the aspect that we're paid directly by you. We don't receive any third-party compensation. Secondly, we have probably among the highest educational levels of education in the profession. My partner in Florida has a PhD in financial planning. I'll just give you our background, and Greg, I'm going to have you talk about yours in a minute too. I'm originally an electrical engineer, and I actually did graduate work in physics, which doesn't help in this profession. But I have an MBA in finance. In fact, I had as a professor one of the people who won the Nobel Prize for modern portfolio theory. But I also have a master's in financial planning. I'm a chartered financial analyst, which is a designation related to portfolio management. And also I'm a certified financial planner, a certified financial consultant, a chartered financial consultant, and a chartered life underwriter. And I've been involved in the profession for years as a volunteer. I was actually a leader of NAFA about 8 years ago. I was chair of the national board for NAFA, and NAFA is a National Association of Personal Financial Advisors. That's an organization that required its members to be fee only. We're no longer members any longer for a few reasons, but not because we're no longer fee only. We still are. So Greg, go over your background.
Yeah, so briefly, I started in this industry maybe about 18 years ago, roughly. And I live what I do. So I was very fortunate that a year and a half into my career, somebody said, you know what, your father's a very successful business owner. Yeah, you're one of 3 kids, Greg, and your mom's a housewife. Something happens to your father, things could get really catastrophic real quickly. So we were lucky that we hired some counsel, got some really good professional and competent advice. So we had proper estate planning documents drafted. We had a trust drafted. We had the right amount of life insurance on my father's life. And what do you know, a year and a half later, he's in a car accident and he passes away at the age of 54. So I had to learn firsthand how to create and protect what my father had built, my mother had built. How do I create an income stream for my mother? How do we not get killed on taxes? And how to shut down a business and what to do with the commercial real estate. So that taught me a lot while being in the profession. And a little bit about me. I am on the board of the Financial Planning Association here in New Jersey. I do frequently work with academics. Specifically, I have a following at Rutgers here in New Brunswick and Newark. So there's quite a few medical faculty I work with. And I'm also on some Rutgers webinars. Steve, you've joined me on them. We've been fortunate to have been giving some advice and counsel on how to think through retirement withdrawal strategies and some input on past presidents and how that affects the market. So that's what we give back to the academic and medical community as well.
Yeah. And I want to mention, we're big on educating our clients, the people that hire us. We we have a YouTube channel called It's Your Smarter Money. And in fact, the recording of this webinar will appear there as well. And our videos, which we probably film 1 or 2 a month, will also appear in Wealth Enhancement Group's YouTube channel as well. And we're really big on having our client. We're very transparent. We want our clients to understand how we do things, why we recommend certain things. There's never any mysteries. Even in, we manage assets besides the financial planning, which we're going to talk about the financial planning in a minute. But the way we manage assets, it's very transparent. If any client asks us, why do you have this or why do you have that? We have a rationale for everything. It's very detailed, and it's almost always based on academic research. There's no seat of the pants type decisions made with respect to managing portfolios. It's all based on academic research. And in the long run, we know that that's going to provide the highest chance that your portfolio will perform well. There's no guarantee, we know that, but it provides, I think, the greatest chance that you'll perform well. And we're also asset allocators. We don't time the market. We choose asset classes very carefully, and our clients all have a broad mix of asset classes. And also, we use a lot of index funds. We use a lot of active managers. Now, Greg, you want to talk about our financial planning process? And, I'll chime in on that.
I definitely do, but I want to take one quick step back to something you said.
Sure.
That we have a process and that it's backed by evidence-based data, right? Some of the academic science. And I think that's really important in today's world, because let's be candid about it. Anybody could call themselves a financial advisor, right? A financial advisor could be an insurance agent. No disrespect to insurance agents, but or a broker, but you don't know exactly what that means, financial advisor. So I think it's really important that when you vet somebody, if you're going to hire professional help, they have a process. They've seen a bunch of clients, hopefully that are similar to you, and have engaged with some maybe more advanced strategies. So once again, we're biased here, but I think it's really important, especially that fee-only component. Once again, you can work with a fee-based advisor that charges commissions. I'm sure they can do a good job for you, but when it comes to managing your hard-earned wealth, it'd be nice not to have any hidden motives or compensation or commission. So that's why we've chosen fee-only, is because truly only the client pays us. And quite frankly, that's the only person that should be paying us.
Well, I like to say that a lot of times that we will refer you out to other professionals for areas that we don't specialize in. So, for example, as I mentioned, insurance, we don't sell insurance. I do have a strong background in insurance because I'm a charter life underwriter, but we don't sell it. But we'll recommend you to insurance agents that we know and trust in case you need insurance. If you need legal documents drafted, we'll recommend attorneys that we know and trust, and we know that they're competent. Same with if you need an accountant, we will act as the quarterback of the team, and we'll make sure that we're involved with these professionals to make sure that what they're doing for you is what you need. And we tend to take the lead in a lot of these areas from the aspect that, and Greg, chime in anytime. We do help you with estate planning. We don't draft documents. We're not attorneys, but we can review your existing documents and at least look at them and say, gee, do they really meet your needs? Do they really meet your goals for your legacy? Do you have a power of attorney if something happens to you? Have you chosen the right people? For example, as a trustee, if you have a trust, or attorney, in fact, if you have a power of attorney, we'll look at all of that. And then we'll make suggestions, very overall suggestions regarding what you might want to consider doing, and also suggestions that you can bring to another professional, as an attorney, for example. And, we'll actually sit in the meetings, too, with the attorney if you want. Our goal is not to try to take the place of an attorney ever, because we don't draft documents, but our approach is to try to help with that, and also maybe perhaps reduce legal fees, because we can help you organize all your information before you even see the attorney, and that'll save some money in legal fees. And the same with accountant. We have accountants we work with that we can recommend. We do a lot of tax planning, and I'm going to have Greg chime in on that. But we do not prepare taxes. We don't do the bookkeeping, but we will help you with tax planning. Greg, maybe perhaps you want to mention something. Also, maybe charitable giving. Also, Greg, perhaps associated with that.
Absolutely. So, just touching base on the financial planning process. So it's very robust, as Steve alluded to. It's not just investments. We're looking at everything. So we're looking at the tax picture, we're looking at estate planning, and we're guiding you along the way. So with our financial planning process, I'm going to go just to talk about it for a second. When we were interviewed by MD Life in our most recent issue here, one of the questions was, what's your process, right? So it's very, very detailed and it's very comprehensive. So this is not some online calculator you're going to get at Fidelity. We're going to look at your expenses, not just what you're spending now, but in retirement, what does that look like? Okay, is it additional vacations? Do we want to spend in those go-go years a little bit extra, the first 5-10 years of retirement, and then taper off? Is it, okay, are you going to be purchasing any vehicles over the next 30 years? That should really be in your financial plan. Are you going to be gifting a down payment to your child? Are you going to be using some of your retirement to fund your child's business? Are you going to be gifting during your lifetime? Are you going to be setting up 529 plans for the grandkids? That needs to be in there. You can't just go off some static number for the next 30, 35 years, in our opinion. So I think that's where we start. We look at your income, your expenses, what's left over, and then we really project out what this looks like over the next 30, 35 years. And Steve, to your point, we use a static simulation, but we also stress test it over 1,000 different trial runs. Whether, at age 80, which is the average age somebody needs long-term care in this country, what if you need to be in an assisted living for 4 or 5 years? How does that impact your plan? What if inflation is not 3%? What if we're heading into a higher inflationary period? What if it was 4%? How does that impact things? What if there's a bear market? The day you retire, Murphy's Law happens.
Right.
Market's down 30%. What does that look like? So I think for the medical community, this is really important to be making informed decisions. You can't just use an online calculator. You can't just have your workplace advisor. And I know there's a lot of listeners on the line that may loosely have a retirement person working through an insurance company, helping them with their 403B plan or 401A plan. And once again, some of the planning they do is very rudimentary and it can be good, but you really need to go that extra mile to make the best decisions and stress test different things to really know where you're going. So I know I'm getting off on a tangent here, but it's very robust what we do. And I think it's important that you're stress testing these scenarios and that you actually have a financial plan, not some retirement projection. You need a full plan that looks at every category because let's face it, taxes are a huge consideration for medical doctors. Estate planning is a huge consideration for them. Oftentimes they are higher earning and they have higher wealth, and the mistakes can be magnified at those levels.
And also insurance too, because you want to make sure you protect your income and you have solid disability insurance as well. You may have it through your employer, and we did a whole session on this probably around November, I think, with an insurance agent that we trust. He was part of the video, and that's on our YouTube channel. But you want to make sure you have appropriate disability insurance, and you may have a group plan, but it may not be adequate to properly insure your income if something happens to you. An awful lot, also life insurance, and not just you as a medical professional, but also on your spouse, because if something happens to your spouse and you have young children at home, you're going to want additional resources to possibly pay for childcare, for example, replace the economic value that spouse provides to you. Even if they don't work, there's economic value, economic life value there. So you want to have adequate life insurance. And so I think the other thing too, that was well said, Greg, but you want to make sure that you don't view planning as a one-time event, and it should be done consistently, because anytime when you're doing this type of planning, you want to review the plan on a regular basis, because things change. Any plan is the Polaroid of the future. We're taking a snapshot of the way we think things are going to look now, but we know things are going to change. Just for example, last year there was a change in the tax laws, and that could have a pretty significant impact on your circumstance potentially in a positive way. But there are also some traps there with that new tax law too, in particular the phase outs. And Greg, I know you're pretty up on those phase outs. And we'll talk about it in a minute, how we do tax planning, but go ahead, Greg.
No, I was just going to say that is the perfect segue. So for, medical doctors out there, uh, I know we're coming up on tax time here. Take a look at where you're at, right? What was your taxable income for this year? Where were you at? Because for those that are at 500,000 or above,
Hmm.
there's significant implications with the One Big Beautiful Bill Act. So, long story short, we now have SALT deduction being raised from $10,000 all the way to $40,000. But once you hit 500,000 of modified adjusted gross income, well, for every dollar you go over that number, you lose about 30 cents worth of the deduction, not to go below $10,000. So think of it as this: you have 500,000 in income, you go to 600,000 in income in 1 year. Well, guess what? Instead of that extra 100,000 maybe being taxed at, let's say, hypothetically speaking, 35%, when you do the math, it's actually 45.5%.
Hmm.
Almost as you made 100,000, it was almost like you were really taxed at like an extra $130,000. So this
Yep.
is a big deal for medical doctors. You need to be doing planning because the decision to accelerate or defer income can mean getting an additional 30,000 in additional deductions or not.
Yep. Big difference. And if you live in New York and New Jersey also, any state here in this area, you have you pay a lot in property taxes and sales tax. You also, I'm sorry, income tax. There's now a $40,000 SALT limitation. It used to be 10, but that SALT limitation also gets phased out, and you have to be careful with that. Also, if you're nearing retirement and you have a lot of money in an IRA, you may want to look at Roth conversions, and that's a complex issue too. And you want to look at Roth conversions probably when you first retire. You may be in a much lower tax bracket. It may make sense if you have a lot of money in an IRA, or a 403b or 401k. When you hit age 73, you're going to have a huge required minimum distributions, which could do a couple things. Could put you in a high tax bracket. If the phase outs which exist now still exist, it could cause you to lose those deductions, and additionally could affect your Medicare premium. Something called IRMAA. And so it may make sense to do Roth conversions carefully before you hit RMDs, and also perhaps before you start to claim Social Security. And I know, Greg, you've looked at a lot that in many cases, those that are Roth conversions as well.
Yeah, no, for those that are listening, you want to find a way to lower your lifetime tax bill. This is potentially a way to do it. So you have to be smart about it. There's a lot of pitfalls that can go wrong. You may be thinking, oh, well, I'm in the 32% tax bracket. I'm going to do a Roth conversion up to the 37. But when you do the math, it's actually your rate is 45%. So it's not a simple, easy thing. Or even if you're at the lower tax brackets, I think I'm going to convert and put into a Roth up to the 24% tax bracket. Well, as Steve just said, between IRMAA, between the net investment income tax, well, now you're looking at a 30% tax rate. It wasn't 24 like you previously thought. So got to be running multi-year projections. And Steve, I know you'll talk about this, but this is part of the work we do for our clients. Once again, we can't give tax advice, but we can engage in tax planning. And Steve, I know you do a lot with our clients on that as well.
Well, I like to joke, many medical professionals have accountants, but all they do is prepare taxes. And I like to say, and I stole a joke from someone else, they like to bayonet the wounded. They're going to tell you after the fact, well, you owe this much money. The idea is to try to plan ahead so you owe less, legally, of course. By the way, another idea is we're going to jump into the realm of investment a little bit. If you have a highly concentrated stock position, perhaps you bought NVIDIA, for example, and you've made out like a bandit on it. It performed quite well and now represents a good portion of your portfolio. Well, you have an issue there because you don't want to have a highly concentrated stock position. We did a video on that about a year ago. It could really represent a threat to your net worth. Because, I've seen it happen too many times with a high-flying stock suddenly either languishes for years or actually drops a lot. So one great idea, and this leads right into charitable planning, would be to consider, especially if you're older, use a charitable remainder trust or a charitable remainder unit trust, which we talked about, I think in December. And contribute that stock to that trust, have that trust sell the stock without any capital gain because it's meant for charity, and you can actually invest that money in a diversified portfolio and receive income from it for a period of time or for the rest of your life. Now, there's other charitable ideas too, Greg, which also can reduce your taxes. You may want to mention them. So,
yeah, absolutely. I mean, tax planning is a huge thing.
Yep.
And we just spoke about with the one big beautiful bill that phase out between
Mhm.
500,000 of modified adjusted gross income and 600,000. Well, a smart idea could be, if you're charitably inclined first, is especially if you're 70 and a half or over, we're finding a lot of medical faculty and medical doctors are working past age 70, and maybe they retire at 72 or 75. Well, guess what? You have access to what's called a qualified charitable distribution. So all that is, you have to have an IRA to do this. You cannot take money from a 401A or 403B. It has to come directly from an IRA. But in essence, for 2026, you could take $111,000 per person if you're married filing jointly. So 111 times 2 you could do theoretically if you both have IRAs. And you could take $111,000 and directly send it to a charity, a nonprofit organization, 501c3, and that could proportionately reduce your required minimum distribution. It comes right off of your taxable income. So it's a great way to save, great way to donate to charity and also get a big tax benefit.
Yep.
But if you're in that phase out range between the 500,000 and 600,000, that's even better, because there could be a way to do enough of a qualified charitable distribution to actually get you under that 500,000 level so that you can get the full 40,000 in additional deductions for SALT, state and local tax. So that's a very, very more tax efficient strategy from the passing of the One Big Beautiful Bill Act. And also know that for this year and for the next, I believe, 3 years,
yes,
there is a floor on charitable contributions, itemizing charitable contributions. So that's a 0.5% AGI floor. So to put that into context, if you have a adjusted gross income as a doctor of $500,000, you cannot deduct anything under $2,500. So if you do 10,000, you gift to charity, your AGI, your 0.5% AGI is 2,500. You're only going to get a deduction for anything over that $7,500.
Yep.
So a way around that is maybe you want to contribute to something called a DAF, a donor advised fund, which is basically a fund that you can put your money into. It's a pool of money that's for charitable purpose.
And by the way, it could be invested any way you like. So within a DAF,
you can put it in index funds, mutual funds, and you basically give grants. You could do it in 1 year. You could do it over 5 years. You get an immediate tax deduction for doing that. And that's a nice way to kind of, instead of just donating, let's say, $10,000 a year and only getting $7,500 worth in a tax benefit, this is a way to, kind of skip those couple years, get an immediate tax deduction today, and have more charitable dollars working for you.
It's a great idea. It is. It's really a great idea. And by the way, tax planning should happen throughout the year. And so what we're doing now for clients is we're taking their last year when it's available, the 2025 return, and we're creating a 2026 projection, and we're modifying the numbers in that 2025 return with how things look today, how we think that things are going to look for this year, and we're looking for opportunities based on what we know now and throughout the year, by the way, because things might change through the year. And there's some things they can do even toward the end of the year in December. So we're looking at that throughout the year for most of our clients, these opportunities. And another idea, by the way, if you're in a really high tax bracket and you have a 401k, you have both a Roth and a traditional pre-tax 401k. If you're in a 35% or 37% bracket, it probably doesn't make sense to do the Roth. You may do the pre-tax. So we like to take advantage of something called tax arbitrage. We like to have your money taxed at a lower rate in the future. So in that case, what you're doing is you're deferring taxation from a time when you're in a 35 or 37% bracket to potential when you're in a 22% bracket in retirement. So we always want to take advantage of things like that. Now, granted, we don't know what tax rates are going to be that far in the future, but if you're closer to retirement, we may have a pretty good idea. We may have some certainty around it. So there's all kinds of tax planning opportunities that we can probably come up with that can help you.
Now, let's pivot here. I know there's probably a lot of medical doctors on the line who know about investments, right? A 60 portfolio, low cost investments. And while they're a good way to invest, maybe something to know about our group that's a little bit different is our process when it comes to investments. So, Steve, I know a lot of people say, well, can I really be diversified, right? I'm in a 60-40, low cost, everything goes up, everything goes down. What are your thoughts on that and how it relates to our process here with investments?
Yeah, well, we use a lot of non-traditional asset classes, actually, and our approach is based on academic research as well. We use a version of modern portfolio theory, which won the Nobel Prize in 1990. And we've actually adapted many of the improvements that have been made in that theory mathematically over the years. We have proprietary software which helps us create our asset allocation strategies. And we have non-traditional asset classes, as I mentioned, like we do use hedge fund strategies, long, short, merger arbitrage, and variable arbitrage. We use ETFs predominantly there. We have natural resources, which really shined when inflation hit 9% in 1 year, at least for a quarter. I think it was 9%. Natural resources was one of our best asset classes, and also held up well, by the way, in 2022, which was a bad year both for bonds and stock, by the way. And there was actually a Vanguard, well-known Vanguard ETF, the symbol's BND, that was down about 16 or 17% that year. None of our bond holdings were down anywhere near that. We use individual bonds predominantly, by the way. Municipals with the highest quality. We don't typically use corporates, but we'll use any other type of bond that doesn't have the risk of that corporates have, because we're always concerned with that risk. We also use reinsurance bonds, which is a really interesting asset class, since it's provided a very high return on average over the last 5 years. We have probably 12 or 13 asset classes in client portfolios, and we use a lot of index funds also, because we want to keep costs down. And we also I don't have faith in most active managers, quite honestly. And Morningstar statistics bear that out. And we have the statistics. We're happy to share it with you. Through time, the number of active managers that can actually match or beat their benchmark, it declines each year. So by the time you get 10 or 15 years out, maybe it's maybe 9 or 10% of active managers can actually beat the S&P 500, for example. With asset classes that are very efficient, like the S&P 500, I think there's very little value an active manager can add. All of the public information is out on all those 500 companies. Unless they have some kind of dream in the middle of the night and decide, gee, I have a crystal ball and I can predict something. I think most can't really beat the market in the long run. And if they seems like they have, I think it's more luck than manager skill. And we can actually show some of that statistically, by the way. Something called the information ratio, which I won't explain here, but you can kind of show, not with absolute certainty, but with some certainty, rather, if an active manager does seem to outperform the market, whether it was skill or luck, to some extent. And I've seen it. I've seen active managers that apparently outperform the market for 3 or 4 years and give it all back in 1 year. So we really believe in index funds, but we use different types of index funds, by the way. They're a little different from the straight capitalization weighted. And we'll probably should do a whole video on that at some point too, for medical professionals. But we're big on a lot of different asset classes. We also have international, which actually really performed well last year. It languished for years, quite honestly, but we don't make decisions because an asset class languished for years, because suddenly in 1 or 2 years, it can suddenly catch up to the other asset classes. And international was up about 30% last year. And, international small cap, which we hold, was up about 50. I'm not going to predict that's going to happen in the future, but I'm just telling you what happened last year. And we've always had these asset classes. It's not something we just decided a year ago, let's add these and be, and suddenly we look like heroes. We've had them for years. The idea, by the way, is to try to match the model, the portfolio that you're in, with what rate of return you need to earn to retire properly and retire without having your money run out. And that's why that retirement analysis part is so critical. It'll give us a rough idea of what rate of return you need to earn on your portfolio, such that you don't run out of money. And we use a statistical process, by the way, in the retirement planning, to run through thousands of trials, because we know investment return is semi-random each year, even on a diversified portfolio, as is inflation. It's called Monte Carlo, which is kind of a silly name, but it comes. I'm not going to explain where that name came from, but it's a statistical process that we use to try to make your financial plan more bulletproof. There's no guarantees. We know that. We want to try to make it as robust and bulletproof as possible. So, yeah, thanks for that, Greg. I think we're almost nearing the end. Go ahead.
I'm going to just make 2 points here, because you brought something up I think our viewers may want to hear. One, and even if you're not afraid of running out of money, you're a late career doctor, you're doing very well for yourself. We see those all the time. Well, yep. One, do you have a taxable estate potentially 15, 20, 30 years from now? Yep. Is it possible the assets you own could be worth $15 million per person, or it may go down at some point?
Yeah.
And then even if you're not subject to a taxable estate and you still have done very well, right? You're north of $5 million, $8 million, $10 million. Well, that's a little bit of a gray area, but do you have more than enough you need to live on to have a nice retirement? What is, are there any assets you can irrevocably part with and maybe do other things with? So in other words, what is your core wealth and what is your surplus wealth? Because perhaps you have enough to have a great, robust retirement, but maybe you should be thinking about gifting or setting up trusts to see what to do with the surplus. So we can help you identify that, which I think is really helpful and unique about our planning process. Yep. And then also, to touch base on the investment piece, I'm going to make a little bit of a broad statement here. The medical doctor or the physician who has more assets to draw on or different assets to draw on in retirement wins. So what do I mean by that? You mentioned stocks and bonds were down in 2022, right? BND was down 17%. I'm sorry, was down 13%. The stock market was down 17% in 2022. Yep. Well, some of the alternatives, they did well. So the reinsurance bonds, things like the natural resources that we have, you want something that can zig when the stock and bond markets zag.
Yep.
Because that's going to allow those markets to recover, and ultimately you're going to end up with a higher terminal wealth at the end of the day. And by the way, when you have alternative investments, that means you don't have to need as much cash in your portfolio. And guess what? The more cash you have in your portfolio, multiple years of cash, your failure rate goes up dramatically. When we see somebody who has 5 years worth of cash versus somebody who has 1 year worth of cash. So, you don't want to be losing money. It feels good to have a lot of cash on the sidelines, but the reality is you're probably not making much after inflation. So that's how our team can help and get your money moving in the right direction.
At the very least, you want to have that cash potentially in some municipal bonds, and depending on your marginal tax bracket, you could have a pretty high tax equivalent yield. But it's also money you can tap pretty readily, especially if you have a blend of maturities in the municipal bond portfolio. If you need to sell some that are only maybe maturing a year or two in the future, we know bonds go up and down with interest rates. The potential loss in value in those bonds will be very small. But you at least in the long run, you'll be earning something. You could earn a 5 or 6% tax equivalent yield on those municipals. So you're right, Greg, about not having too much cash. It's a good point.
So I think this may be a good ending point here.
Yep.
Look, work with us, people. This is our first time here on LinkedIn Live. We have a chat that's open. If you have any questions, feel free. We'll open it up for the next 2 minutes. And just work with us. We're rookies here. And I think it's also important to note on this call here that not only do we publish for MD Life, we normally have these videos recorded. You can catch us on our YouTube channel. It's Your Smarter Money.
Yep.
So just go on YouTube, It's Your Smarter Money. You can find our Atlas team here at Wealth Enhancement, get all of our educational videos. There's no sales involved here. As you can see, we're very educational in nature. That's how we roll. And Happy to
I
be a
also
resource.
want to mention that we've put together a compendium of articles from MD Life into an ebook, and we keep adding each month's article to the ebook. You're welcome to a free copy of that ebook, and it has a lot of the points that we've made here in this video and others in the ebook, and we're happy to provide that. And we're also happy to, if you're interested in talking to us, we always offer a free consultation with no charge. Just to kind of get to know us type of meeting, see whether you feel comfortable with us. So we always offer that, and you're welcome to reach out to us and contact us if you want to do that. And we can do it in person or virtually, either way. And then at that point, if you do feel that we can help you with your circumstance, you're free to contact us after that, and we'll give you a firm idea what we charge on that. I mean, again, it's very transparent. There are no secrets.
So maybe with that being said, we don't have any pressing questions. Be on the lookout for our next MD Life article. By the way, if you ever want to see that issue that we put together every month, you can also contact us. We're happy to send it to you. Our webinar will be recorded today. You can find it on It's Your Smarter Money.
Yep.
And until next time, we'll see you soon.